Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
Welcome back to the podcast. Hey, Dan, what's up, buddy?
Not much, man. How are you?
I am doing fantastic. I got a positive outlook on 2025.
Yeah.
And it's a perfect segue to our conversation today. So, we're going to talk about forecasting and how do you look ahead and how you prepare for this. So, one of the things I want to talk about is just the outlook of 2025. So, Federal Reserve is projecting that everything will stabilize, right? We're not expecting any promising major cuts or anything like that, but we could plateau a little bit. Mm-hmm. And so let's just jump right into that. Talk about what's your thoughts on the stability of 2025. We're going to get into about rates perspective, but also just even employment, I think, is going to be a huge factor this year. So yeah, let's just talk about a little bit about the market outlook for 2025. What are your thoughts?
Yeah, I think let's think about the Federal Reserve. That's a pretty important topic.
Okay.
A lot of there's like this huge misunderstanding about what the Federal Reserve rate actually is and what it does, right? Mm-hmm. And a lot of people, when the Federal Reserve announced, at the end of 24 that they were going to make 4 to 5 cuts. This is after 9 consecutive increases, right?
Yeah.
And that they were going to make 4 to 5 cuts, quarter point cuts was kind of the prediction. That assumes that inflation starts to stabilize. But what people got lost in that is they thought also that meant, well, mortgage rates are coming down, right? I mean, I remember the first or second, after the first or second cut, people were going, oh man, mortgage rates are going to start coming down. The two are not the same. The two things are not equals, right? And they're not even synonymous in a lot of ways. It's a big difference, right? And so housing market is historically driven by mortgage rates and affordability. Mm-hmm. So those are kind of the two major drivers. So now the Fed rate is going to help affordability. It ideally would make the cost of capital for people that are borrowing, manufacturers, et cetera, start to come down so that people would start spending again, right? That's the whole plan. Spending just got out of control during COVID, so you had to increase the rates. Otherwise, pricing would have just gotten out of whack. So I think what we're talking about is really just like, they're two separate things. Mortgage rates, if I had to predict, and I think we did on the last episode, is where rates are going to go or where they're going to be.
Right.
All of the leader economists in that space are kind of predicting like stability somewhere between around 6 to 6.5%. That's kind of where they see the market balancing out, is at 6 and 6.5% on a 30-year fixed mortgage rate, right? But the Federal Reserve rate, I mean, that thing could come down 2 points and have very little effect on mortgage rates. So don't get too caught up in that. Now look for those savings with your manufacturers and stuff like that, right? That's where I think you'll start to see some of that stuff. Hopefully pricing of that stuff, comes down, your material goods and whatnot. But not if people keep buying it. Mm-hmm. Not if, if the market's showing that there's demand for that stuff at that price, the prices are not going to come down. And that's economics 101. That's just how that stuff works. So, I think that, inflation has pushed the housing market quite a bit.
Yep.
It was like, okay, if the cost of eggs goes up by 20% and the cost of home prices went up by 20%, well, I guess everything's just 20% more expensive.
Right.
And that's not normal. So, we could see that the cost of eggs going up by 20%, but housing 20, that's a lot for an economy to take in. So
Yeah, we're seeing a little bit of that with the cars, right?
yeah,
There's so many cars on the car dealership now. We're not talking about cars today. Obviously, we talk about real estate, but I've seen a ton of inventory
yeah,
out there. And I
yeah,
think just folks are just thinking everything through,
yeah,
right? Everything is more expensive, but not to mention employment trends have a huge impact to this as well, right?
yeah.
Yeah.
Yeah, it's tough out there. I mean, and I think we talked about it before, was just the fact that like household incomes haven't gone up at the rate of inflation. And if they did, we'd be having a totally different conversation,
Yep.
right? But the reality is they did not. And price of everything goes up. Eggs went up by 20%. It's not like you got 20% more in your paycheck to cover the cost of those eggs. You just have to live tighter, and that's what everybody's dealing with.
Yeah.
I mean,
Yeah.
that's what everybody's kind of rocking and rolling on. So, look, we got a new administration, I mean, they're about to take office, and I think like that's gonna have some interesting effects.
Yep.
I don't know right away like how quickly you could see the impact,
Yep.
but I think it's gonna be an interesting year for sure. And employment is now a big question. There's a lot of false information that we get, right?
Yep.
Where like, big employer lays off a bunch of people and everybody's like, oh, no big deal.
Yeah.
Well, that's a big deal.
That's a huge
That's a
deal.
big deal.
Yeah.
And so like, how do I think now hopefully we start to get a little bit more clarity around what the actual employment numbers actually are.
Yeah.
Because I think that could help pricing. To your point, like the premium in cars can't sustain if people are out of jobs,
That's right.
and people are fearful of their jobs, then they're going to be less likely to just frivolously spend.
Yeah.
So, therefore prices of things are going to start to come down a
Yeah.
bit, which,
Yeah.
could be good. It stings, right? It's not like we love a market like this, but to me, it just seems necessary. I don't know any other way that we can like live if we don't kind of balance the cost of
Yeah,
things.
yeah, absolutely. And, we don't mean to be all doom and gloom, but
No.
as things start to stabilize, this is a good thing because sellers may have more confidence to put their home on the market now, right? I saw another report where builders' activity is increasing as well. So that means more inventory,
Yep.
right? So those two things, inventory and home prices, could play out to be a good thing for folks, right?
Yeah.
Yeah.
Yeah. I mean, you're seeing like, there was, like Southern California and San Diego, just in San Diego alone. I'm trying to remember the exact statistic. I've heard it is, I think they are short somewhere in the neighborhood of like 1.5 million, units,
Wow.
housing units
Yeah.
in San Diego, like proper.
Wow.
So in order to beat that, I mean, if you've been to San Diego recently, it's not like there's just like a ton of land available,
Yeah, exactly.
In order to beat that, what they started to do is allow homeowners to put PDUs like in their backyard, right? So they allowed or ADUs in their backyard. So they allowed them to put these small like casitas
Yeah.
in their backyards that they could rent to somebody else and they can get some additional income out of that. They've even like increased the density rules. So like the setback requirements for all of those things have basically been all but eliminated.
Oh,
So you
wow. I
can
didn't
just like,
even
it's
know
going to be
that.
super dense. Yeah. Cause people are putting them in everywhere. But you could also like buy like a house on a regular street now,
Right.
tear it down and put up a fourplex,
Wow.
without having to go through a big rezoning issue. So I think it's interesting what municipalities are doing to play. And then the builders, we still like housing stock is still down. Last I read, it was somewhere in like the 4 or 5 million range was the number of units that they thought we were short, in the country. So if that's true, I mean, the only way to go is to build them.
Yep.
You got to build new houses, and, those new homes are going to have to be built somewhere,
That's right.
So those guys that took those bets on those outlying markets are finally going to start to see some of that activity come true.
Yeah. What about on like the pricing side? So like CoreLogic and Zillow, while they're predicting small growth is still positive growth, right? Are you seeing those same trends there as well?
I think so. I mean, I think the home value is something we've got to you got to really start keeping an eye on. I mean, with supply creeping up the way it is, in my opinion, and this is strictly my opinion, is just that as supply increases and demand stays the same and affordability stays the same, I think you gotta see some adjustment to pricing.
You have to, right? You have to.
So the argument could be that like maybe the pricing was artificially high, and therefore needs to come down quite a bit. And then I think you'll start to see activity trade. Again, I mean, this was the lowest number of home sales in 30 years in the U.S.
Yeah.
30 years, right? Like that's crazy to think that we've never seen, as little activity as we saw in 2024. Let's hope that trend doesn't continue.
Yeah.
And, things start moving again. And people just have to get used to the new world of pricing. That's the new balance.
Yeah.
And we'll go from there.
I'm in my head, you got my head spinning right now because you got me thinking about data even more, right? Using data. So understanding where I'm going with that is these hot markets or these hot areas. I think I like Denver. I think like even I read something like Miami as well. These markets are continuing to grow, right? Now, there are some that are trending the opposite way.
Yeah.
But again, when you're investing, using data to make these decisions could be huge. But understanding these hot spots and understanding these markets where you could still see positive trends.
Yeah. Yeah. I mean, you've got to be able to keep an eye on those trends.
Yep.
I mean, especially if you're investing, you've got to be able to look at and go, hey, where am I going to get the biggest return on my dollar? And if my dollar is better spent in Denver and I live in San Diego, okay.
Yep.
That's where the opportunity is, and that's, it's a 2-hour plane flight, Roy, right?
That's
It's not all that scary when you're using data and analytics to make those decisions.
That's right.
I think it helps you get comfortable with them, but you got to know them and understand them and then trust it, and trust that information so that it's, it leads to some sort of a success because, if you don't, now you're just betting on like a totally subjective view of what's happening, and that's, I don't know how long you can live doing that. That's a tough one.
Yeah. Now let's flip the script a little bit and talk a little bit about the trends and forecasting for renting and institutional activity. So the National Rental Home Council is projecting that rent will increase 5 to 6%, right? Or rent prices will increase 5 to 6%, basically driving a high demand of limited rental inventory. So if you are an investor out there, look, this is a positive trend from a long-term investor standpoint. So maybe not so much on the fix and flip side, but I'm talking to my long-term rental folks. This is a win for you when you look at it from that view. More and more people are renting. Yep. Right. What are your thoughts there?
Yeah, I agree. I mean, I think if you could think back on the fundamentals of like buying real estate, home price appreciation is a byproduct. So buying the house and then it appreciates by double is not a conversation that our parents used to have.
That's right.
That's not a thing, right? So if you take that off the table, then really what is real estate investing? You buy a house, you put a mortgage on it, your tenant covers the cost of your mortgage, maybe you make a few bucks on it, but then in 15 years from now, when you pay off that house, 30 years from now when you pay off that house, whatever long you have the mortgage, you haven't taken any money out of your pocket to own and buy the real estate.
I love that.
Right? That's how, like, that's the fundamentals of it, right? And I think, people get too caught up in home price appreciation because it's like in the last few years, it's been like the sexiest topic in town, right? Oh, my home price appreciated by 40%. Cool. That's great. How about you make like 2 extra mortgage payments and start paying the mortgage off? Because that's when you're actually going to get, some true equity in this deal, because that equity isn't easy to tap to. It's not easy to get home equity lines, right? And so I think it's important that, like, if you think about the fundamentals of real estate investing and just look at it from the straight perspective of like, I'm going to buy 5 rental properties. I'm going to, own them for 15 years, put 15-year notes on them. And I want these tenants to pay these things off. And in the end of 15 years, you own the real estate free and clear. Now you're either A, getting all that rental income.
Exactly.
Or B, you can sell the assets and you've now got a bunch more equity, but someone else paid it for you as the tenant. And that's the fundamentals, right? That's like that's the real meat of real estate investing that, for some reason it's just gotten weird in the last few years. Like people are like, oh, that area is not going to appreciate. And I'm like, but it rents, like it's going to rent really well,
Yeah, and I want to really talk to the mom and pop investors really quick, because institutional investors, they've adopted to this, right? They have adopted or adapting their new strategies for this. And so what I mean by that is they're leveraging technology, they're looking at data. Ultimately, how do I optimize the most returns for me? And so if you're out there listening, right, again, use data, understand trends, understand hot markets. And so that way you can make a huge sound decision. But I think it's just fascinating of how much data and everything impacts folks' decision. But I can tell you right now, the institutional buyers, they're adjusting. And so we, as the mom and pop investors, we need to adjust as well, right? And use data behind those decisions. Right. Are you adjusting, Dan? Are you
You got to, man. I mean, I think I was a victim of this idea that rates were going to come back down to somewhere.
Yeah.
I've just kind of given up on that idea completely. I have no reason to believe that rates are going to fall to I don't know that in our lifetime again we could see 3% interest rates. I just don't. I can't see a world of why we would. So with that said, okay, how do I make money now? How do I make money in this market? Yes. How do I do what I'm going to do now? And I think that's where everybody's adjusting, including, your bigger investors. They've been waiting on the sidelines for, a lot of them have pencils down for 2 years, just waiting for some sort of a correction. Well, now they're starting to look at opportunities and go, well, maybe we can buy properties, when people need to sell, and we can be a good option for those that need to sell, and offer certainty and, make offers. And if they don't accept our offer, that's okay. But, that's where we need to be, because rents are what they are. And, this is the number we're stuck on. And they're not embarrassed about having to do that right now. So I think you're going to start to see a lot of activity, from the larger investors. Maybe not, Q1 isn't going to be like gangbusters, but I think start getting into Q2, you're going to see a lot of activity by those groups. For sure.
I think you're going to see some inventory improvements for sure. But then you're also going to see a huge increase in financial creativity, right? There's a ton of players that are coming out to help people with alternative financial options. Have you heard of any new options out there that folks aren't thinking about, or with anything you can share there that could help reshape how people get prepared for financing?
Yeah. From an investor standpoint, there's a lot of buzz around these like subject to transactions where, you're essentially buying someone's position on their own note, right? So the seller stays on the mortgage and you're wrapping that mortgage. You're staying on top of it. High risk stuff, right? It's new age, high risk kind of investing. It's interesting. And what they're buying is the low interest rate on that mortgage, and that's what everybody wants to own, is those 3-4% mortgages. That's what everybody's trying to get their hands around. So I think you're going to see a lot of alternatives that, lead people to those. The other one that I think is interesting too is we're working with a company called Sell and Stay. And what those guys do is you sell your property to them at, somewhat of a discount.
Right.
But then they take part of the equity and roll it into rent. So you stay in your own home, right? You owned it.
Yep.
You sell it to them at somewhat of a discount. And then they're going to also prepay rents for a certain period of time for the first year or 2 years.
And I get to keep that cash?
No. I mean, the equity that you earned from, whatever the final settle price is, right? But you get to stay in your house and you no longer are responsible for the maintenance on it.
Another creative way. Yeah,
Right.
that's
So
awesome.
I think you're starting to see, a lot of people kind of look at it and be like, man, I would sell this place to put a little equity in my pocket, but I don't want to move. Like, where am I going to go?
Right.
Where am I going to buy? And so the opportunity of like sale leaseback, I think is pretty cool. Seller financing, people are coming in and they're financing deals,
Yep.
You've got a lot of equity in your property and a very low mortgage. It's not a terrible way to go, because you can charge a new buyer coming in an interest rate that's prevailing and make money that way.
Yep.
I know a lot of guys that flip and then they seller finance those flips, and that's a great way. I mean, it's almost like owning a rental property without owning a rental property, because you're making interest on your money that's sitting out there, your earned capital that's sitting out there. And if you can do it right, those seller carries are a really cool option, and path to investing for sure.
Talk a little bit about the financing side, because so many investors out there think they have to have $500,000 to get started, right?
Yep.
And this may be, and I think we had an episode in 2024 about this, but maybe we need to go in depth about financing your LTR or financing your flip. You don't necessarily need 500 grand. You can get started with just the 20% down, right? Can you just tell our listeners a little bit about that as well as they think about alternative financing?
Yeah, I mean, the financing you're talking about is, what we would consider like the layman term would be like hard money.
Right.
The probably more institutional term is asset-based lending, right? And what they're talking about is like you as the borrower we're not that interested in you. What we're more interested in is what the asset is, right? And if the asset, if I'm buying the property at a discount and I know it's at a discount as the lender, I'm in a pretty good position in case the borrower defaults.
Yep.
So I kind of, could care less if the borrower defaults. I mean, that I don't want you to, but if you did, I would be in a pretty good position as the owner of the note, because I can foreclose and now I own the real estate. So asset-based lending, is popular, especially for those that are looking to flip. And the other asset-based lending types out there, like DSCR loans, debt service coverage ratio loans. So, can you rent the property for less than your cost of this loan? And if I can, like, as a lender predict and be like, yeah, I mean, he's going to rent it for $2,500. His payment to me is going to be $2,000. I'm in a pretty good position as a lender. I would do that deal for you all day long.
Yep.
Right. And now you can arbitrage the debt.
There it is.
And make a decent spread, and the lender's happy. Yep. So asset-based lending is easy and super, super favorable. And the terms, like the DSCR terms, aren't too much greater than what you're paying in the conventional market today. Yeah. Maybe you're paying like a point premium or so for those types of loans. Easier to get, and you don't have to jump through as many hoops. But definitely a really cool option if that's a direction you want to go. So yeah, I mean, even like flipping, you want to invest. We have flippers that are putting 10% down on 10% terms. So the cost of their capital is 10%, and they're putting 10% of their own money into these deals. That's pretty good. I mean, like, that's not a huge risk position for you as an investor to get your first couple deals going. I always suggest as you grow to like borrow less if you can, because your cost of capital matters. But it's a great way to get in. It's a great way to start investing.
Oh, that's awesome. So I think if you think about 2025, some big key takeaways, right? It's obviously as rates start to stabilize, inventory improves, continue to watch regional markets, right? Hot trends, understand that. But also there's a growing role in alternative financing and rental innovations. You're starting to see the institutional buyers get more into this built to rent. More financing options are coming out there. So it's 2025 is still very promising. So Dan, like if we were to close with or some encouraging remarks for 2025 along those topics, what would you tell our audience?
Yeah, I think that, what we're getting to now is more of a balanced market.
Yep.
And that's where opportunities start to present themselves. If the entire market is just weighted into a seller's market, then anybody buying, whether you're an investor, retail buyer, whatever, you're in an adverse position. You're competing in a market that isn't going to ever really, no one's going to want to negotiate with you. You're never going to be able to get any deals, so to speak.
Yeah.
But in a market that's more balanced, that's when it might be that there's 10 houses on the street and one of those people lost their job and has to sell their home. Like those are the opportunities that present themselves. And, those that have to sell, of those 10 on the street, 4 of them are for sale.
Right.
Well, that guy who just lost his job and has to sell, he can't list his home for the same price as the 4 that are still for sale and have been on the market for 80 days.
Right.
He's got to be below that because he's got a time clock. He's got to move that thing.
Yeah.
And that's when, those opportunities start to present themselves. We see it every day. We make offers and somebody comes back to us, for $30,000, $50,000, down on their counter after the first counter.
Right.
And you're going, okay, well, something's going on.
Right.
Like these guys definitely want to negotiate. They definitely want to move it.
Right.
Maybe they won't give it away. Like I'm not expecting anybody to do that, but are they willing to negotiate down to a world that, allows the investor to make some money? And I think you're going to see a lot of that activity, a ton. Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.